Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, there could be a perfect storm ahead for households heavily in debt as mortgages reset and a recession hits. Plus, what we eat is big business, but do we pay enough attention to what's in that food? And the cost of greener fuel in Canada is a topic of hot debate. That's all ahead. First, for the week that was in business, it's time for the briefs. Canada's household debt is already the highest among G7 countries and is now bigger than our economy and rising. A new report from the Canada Mortgage and Housing Corporation suggests that consumer debt is a potential threat to the economy as signs of strain emerge amid high inflation and rising credit costs. And at 107% of the total Canadian economy, it's bigger than anywhere else. U.S. debt has actually declined as a percentage of its GDP.
Back in the last recession, the U.S. was about 100% of that household debt to GDP, and it's gone down to 80%. Canada was at 80%, now it's at 100%.
All of that household debt is pushing Canada's big banks to set aside more cash to prepare for credit defaults by their customers. While higher interest rates has slowed the growth of their lending businesses, 4 out of 5 of the largest banks missed expectations for profit in their recent quarterly results, although a couple of them did raise their dividend payouts to investors. Negotiations in the U.S. Congress continued this week on raising the self-imposed $31.4 trillion ceiling on U.S. debt. While most experts agree some kind of settlement will avert the crisis before the June 1st deadline, they also agree that failure to do so could have a pretty immediate and devastating effect on the U.S. economy and, by extension, global markets. Air Canada flew more than 500,000 people over the May-long weekend, which marks the unofficial start to the summer travel season. While the airline is still flying fewer planes than pre-pandemic, it ran them at 95% capacity over the 3-day period. The airline expects to return to its 2019 capacity by next year. Ford Motor Company has signed an 11-year contract with a Quebec lithium miner for a mine that's still in development. Nemaska Lithium has 2 planned facilities in the works and expects to spend $800 million building out its mine and a processing facility in the province. Those are your business briefs. Household debt in Canada may be setting us up for a perfect storm as mortgages reset at higher rates. Many could face steeper costs just in time for a recession that could hit jobs. Robert Hogue is Assistant Chief Economist with RBC. Robert, thanks for being with us.
Well, good afternoon.
So you've got some analysis that actually suggests we may see the unemployment rate tick up to 6.6% by 2024. Characterize how bad that might be. I mean, that's still a reasonably low number by historical standards, is it not?
That's correct. I mean, it would be part of our kind of mild and short-lived recession scenario that we have for Canada. But we know historically that when you have job losses, that translates into various mortgage delinquencies as well as consumer insolvency. So this is more or less what we expect going forward. And actually, we've seen some early signs of it, and certainly in terms of insolvencies in the latest statistics. So I think what we're looking at is this part of the cycle now that we're going to see more delinquencies and insolvencies in Canada. In
fact, you're suggesting it could increase 30%, putting us back to kind of pre-pandemic levels. We saw this real drop in insolvencies through and post-pandemic. How serious is that? What's the knock-on effect, if you will? In other words, it's not just a standalone insolvency, it has an effect on the overall economy.
Correct, but at the same time, as you point out, I mean, we're expecting those insolvencies to go back to pre-pandemic levels, which were not necessarily alarming. So I think, but the thing to keep in mind is that the impact of higher interest rate will have even a kind of a longer-term impact over the coming years. So this is where maybe a little bit more pressure may show up, and we at that stage we could see those insolvencies move up. And our concern is that from a consumer spending perspective, this will have to push some Canadians towards not having to tighten their belt and spend a little bit less or be more cautious. So we're watching it certainly from a macroeconomic lens here.
One of the stories, of course, that got a lot of attention this week, Robert, was CMHC's number on household debt as a percentage of our economy, biggest in the G7, growing, not shrinking, as some of our neighbors are doing. What does it say about us that our household debt is now bigger than our GDP?
Right. Well, it just confirms that Canadian households are very vulnerable to any kind of shock, including further increase in interest rates, for example. So that's something, if you remember going back before the pandemic, that the Bank of Canada was raising it as its main area of vulnerability for the Canadian economy, and that continues to be the case now.
And so just a few seconds here, how anxious are you about where all of this leaves the most typical household in Canada?
Well, I mean, if for those who have debt, that this is they're already, many of them are already under pressure, and that pressure is unlikely to ease soon.
Robert, great to have you with us. Appreciate your time.
You're welcome.
Robert Hogue, Assistant Chief Economist with RBC. Coming up, modern food processing has allowed us to feed many more people much more cheaply. But is it killing us? Stay with us.